A Section 1033 involuntary conversion happens when property is destroyed, stolen, or condemned, and you get paid for it. The tax gotcha is when the proceeds are more than your adjusted basis. That creates realized gain. But Section 1033 can let you defer that gain if you buy qualifying replacement property within the replacement period. On the EA exam, they'll test when there's gain and when deferral is available. Start with the gain math. Realized gain equals proceeds minus adjusted basis. If proceeds are less than basis, you may have a loss, but Section 1033 is mainly about deferring gain. Also, unlike Section 1031, there's no qualified intermediary requirement. You can receive the insurance check or condemnation award directly. The key is what you do next. Reinvest in similar or related in-service or use property. Replacement periods are a favorite exam trap because the clock doesn't start on the date of the fire or the taking. Generally, the replacement period ends 2 years after the end of the first tax year you realize any gain. Then there are special longer periods: 3 years for business or investment real property, 4 years for livestock sold due to weather, and 4 to 5 years for a main home in a federally declared disaster area. Here's how the timing works in real life. If you receive the insurance proceeds next year, the gain is realized next year, and the replacement period is measured from that tax year, ending 2 years after that year ends. That's why a late insurance payout can extend your replacement deadline. On the exam, watch for dates of reimbursement versus dates of destruction. The reimbursement date often controls the gain year. Basis after replacement is another tested calculation. If you fully reinvest, you generally defer all gain, and your new basis is your old basis, plus any extra acquisition costs you paid out of pocket. If you don't fully reinvest, part of the gain becomes taxable. A clean exam shortcut: deferred gain equals realized gain minus recognized gain, and new basis equals cost of replacement minus deferred gain. Condemnation is a special kind of involuntary conversion. It's basically eminent domain. The government forces a sale for public use. Section 1033 can apply to condemnations and even a threat of condemnation if the owner knows about the threat and reasonably believes the taking will happen. Exam tip: condemnation awards can create gain just like insurance proceeds. Award minus basis. For a main home, Section 121 and Section 1033 can stack. First, treat the destruction or condemnation like a sale for Section 121. Exclude up to $250,000 single or $500,000 MFJ if the tests are met. Then, for any remaining gain above the Section 121 exclusion, Section 1033 may let you defer it by buying a replacement home within the replacement period. On the EA exam, the order matters. Apply Section 121 first, then Section 1033. Which of the following items does not decrease an asset's basis? The choices include the cost of defending title to the property, Section 179 deductions, a casualty loss, and a manufacturer's rebate. Think about which one is treated as a capital cost instead of a basis reduction. Think about it. The correct answer is the cost of defending title to the property. That's a capital expenditure, so it increases basis. A tempting wrong choice is the manufacturer's rebate because it feels like income, but it actually reduces the purchase price and therefore reduces basis. Section 179 and casualty losses also reduce basis when claimed. Marisol bought her home 3 years ago. The bank foreclosed on January 10, 2023, and canceled mortgage debt used to buy the home. She received a Form 1099-C. She was not insolvent and not in bankruptcy. How should this be reported? Options include reporting schedules for the home disposition and whether Form 982 is used. Think about it. The correct answer is report the foreclosure as a disposition on Form 8949 and Schedule D, and use Form 982 to exclude the canceled qualified principal residence indebtedness from income. The tempting wrong answer is putting the canceled debt directly on Schedule D or as other income. Cancellation of debt is generally ordinary income, and exclusions, when available, are claimed on Form 982.